Let's continue our whole life policy walkthrough. So we were talking through the flexible protection rider, which is a form of term rider that increases the death benefit. And of course, we have the death benefit payable at the death of the insured. It's the total death benefit. And any death benefit paid will be reduced by loans or surrenders. So if you've used any of the cash value by surrendering it, or if you have any policy loans outstanding where you've borrowed some of that cash, then the death benefit will be reduced by that amount. Just the same as if you sell a $500,000 house and you still owe $100,000 on the mortgage, you only net $400,000. Same thing here. If you have a $2 million death benefit, but you had $1 million of policy loans outstanding, then your heirs only get $1 million. $2 million of total death benefit minus the $1 million of policy loans outstanding. You can also take surrenders, which is instead of borrowing against the policy, you can just straight up withdraw cash. And that's what a surrender is, a partial surrender. We generally don't recommend that because then you stop earning on all of that cash, but you can do that. There could be reasons why that might be a good idea in some cases. But in general, I don't think it's the right way to access the cash, but it's good to know that you can. We're continuing to go through the riders here. All of this is custom designed. I can add more riders. I'm just adding the riders that are typical in most of the cases that we look at, but there are certainly more riders I could have added here. There are riders here that are optional that we could take off the policy. Some of these riders are not necessarily permanent. A term rider, as an example, could fall off the policy at some point by design. Some riders might terminate if you decided not to pay the premium on that particular rider. That rider might terminate, but the base policy would stay in force. Accelerated death benefit rider for terminal condition. This is an important benefit that is on most of the whole life insurance policies that I'm dealing with these days. If you are diagnosed with a terminal illness, meaning you are given less than 12 months to live, you can start advancing yourself that death benefit. Chris Kirkpatrick tells the story about his father-in-law who utilized this very rider, and it literally saved his life. He was diagnosed with stage 4 pancreatic cancer and given 90 days to live. So what did he do? He used a rider like this one, this accelerated death benefit rider, to advance himself multiple six-figure sums of that death benefit on his whole life insurance policy. And he used that to pay for alternative medical treatments that health insurance would never have covered. And thanks to those alternative treatments, he's now alive 2 years later and playing golf 4 days a week and playing with his grandchildren. That is the power of having a rider like this available to you. So if you do have a significant negative health event, you know you have some options, at least in terms of financing. So you don't have to worry about what will insurance cover or how can I pay for these particular treatments. You'll be able to use this rider to do so. There's no cost for this benefit. I like to say there is no free lunch. It's not that there's no cost. It's that it's included. They already underwrote you for the permanent death benefit when they put this policy in force, because technically what they're doing is not giving you an extra benefit. They're simply advancing you a death benefit that they already owe you. They already have that liability on their books. So there's no out-of-pocket cost to you. That doesn't mean it's free. There is no free lunch. It's included in what you've already paid for, namely the permanent death benefit. And then obviously when you do that, the death benefit will be reduced. So in the case of Chris Kirkpatrick's father-in-law, his death benefit is reduced by the amount that he used to pay for those treatments. So again, it's not an additional benefit above and beyond the death benefit. You're simply accelerating, advancing yourself a portion of that death benefit. The amount that you're able to access must be at least $10,000, but no more than 50% of the eligible amount, with an overall maximum of $250,000 per policy. So that's interesting because if you're a true believer in the infinite banking concept, you're going to end up with multiple policies on yourself. So this can be an advantage to having multiple policies on yourself rather than just one large policy. Typically, the reason why we have multiple policies is simply because your income, your assets, your net worth grow over time. And so your need for death benefit and financing and cash value accumulation grows over time. And so you end up with more policies, because the policy you can afford at age 25 is significantly smaller than what you can afford at age 55 when your income and your assets have hopefully grown exponentially. The amount of the claim actually received will include the following reductions. So premium payments that would have been paid during the 12 months following the benefit date, a loan repayment equal to the requested percentage times any outstanding loan balance, a 12-month interest rate discount using a rate guaranteed. I know this is a lot of technical jargon, but what this is saying is that when you accelerate your death benefit, it's not going to be a dollar for dollar reduction in the death benefit. So if I advance myself $250,000, the death benefit won't necessarily be reduced by $250,000. It'll probably be more than that, because the insurance company is going to discount it based on what they would have earned on that $250,000 as well during that time. So how much depends on your age. The younger you are, the more that death benefit will be reduced. The older you are, it might even be just a dollar for dollar reduction. Suffice it to say, there is a formula for how your death benefit is discounted. It won't necessarily be dollar for dollar. Also, your premium payments will be reduced going forward, because now you're going to have less death benefits. So let's say you survive that terminal illness, as sometimes happens, and you end up living another 5-10 years. The premium payments that were due, if there were any at that point, would be reduced because you're paying for a smaller death benefit now. Your death benefit has been reduced. Same thing here with loan repay, a loan. If there's an outstanding loan balance, that would complicate things a little bit as well. The accelerated death benefit is usually income tax free. It should be if it's managed properly, because it is an insurance claim. It's not income. As long as you manage this policy and the benefits properly, and all benefits should be tax free, whether that be death benefit, cash value, this accelerated death benefit rider. And this goes into a little bit of the IRS code, but basically explaining why this could be a taxable event if you don't manage it properly, but it shouldn't be. It's an insurance claim. You didn't realize a capital gain. You didn't get some big investment return. You were diagnosed with a terminal illness, and you exercised an insurance policy that was protecting you in that event. Just the same as if your home burns down and the insurance company pays you $500,000, that's not a $500,000 gain. You're being compensated for the loss of your home. The accelerated death benefit rider is a life insurance benefit that also gives you the option to accelerate some of the death benefit in the event that the insured meets the criteria for a qualifying event described in the policy. This rider is not a long-term care policy or nursing home insurance policy. This is legalese explaining that this is not a long-term care insurance policy. It's technically true. That doesn't mean it cannot help in the event of those things. Just like having a lot of cash in a bank account could help you in the event of a long-term care need or terminal illness. This can be used to help you in those events, but it's technically not a long-term care insurance policy or a nursing home insurance policy. The accelerated death benefit, this is different from what I sometimes call the long-term care protection. There's a different rider that, while it's not long-term care insurance, it does protect you in the event of a long-term care need. We'll come to that in a second. This is protecting you not if you have a long-term care need, but if you are diagnosed with a terminal illness. And then it gives you a hypothetical example. So here he was age 35 at issue and age 44 at the payout. So this would be very young. 44 would be extremely young to be diagnosed with a terminal illness. But if, God forbid, something like that were to happen to you, you could utilize this. He's going to accelerate to himself the maximum $250,000, and they are discounting the death benefit by 5.3% annually. That's the interest rate they're applying. That helps him to determine how much will the death benefit actually be discounted. But notice he was paying a $25,000 premium. After he accelerates that death benefit, if he were to keep paying premiums, keep the policy in force, his premium will be reduced to $23,000 because now he's paying for less death benefit. His cash value was $247,000. Now it's $206,000. So that's reduced by about $40,000. And the face amount went from 1.58 to 1.319. The total death benefit went from $1.6 million to $1.3 million. So notice it was actually a little bit more than $250,000 as your death benefit was reduced by. So I'm going to pull up my calculator and we're going to do $1,591,609 minus 1,326,268, $265,000. He took $250,000 out of the death benefit, but the death benefit was actually reduced by $265,000 because of that discounted amount. There's some math behind that we're not going to go into. You'd have to be an actuary or an underwriter to know what that would be. Now we come to one of my favorite riders, the chronic illness accelerated benefit rider. This is the long-term care protection in the policy. Notice I'm not saying long-term care insurance because it's technically not a long-term care insurance policy. There are some ways in which a long-term care insurance policy would be better, and there are some ways in which this would be better. It really depends on you. The beauty of it is you're not paying for this rider out of pocket. So this is already included in what you're getting with the policy. It's a phenomenal added layer of protection. And if you wanted to supplement this with a true long-term care insurance policy, that will be fine. Or if you wanted to take out a whole life insurance policy with a true long-term care rider, that would also be fine and potentially provide more robust coverage for long-term care specifically. But obviously the cash value growth would not be as competitive because you're structuring it more for long-term care benefits. The way I've structured this policy assumes that we're primarily interested in cash value accumulation over the long run, and long-term care protection is an added bonus, but not something we're really trying to maximize. But if you start taking out policies at age 35, by the time you reach age 65, you'll have a pretty decent amount of death benefit there that could be used for long-term care, that could be plugging a huge gap, both financially and psychologically, in your retirement plan, just knowing you have this as a backstop should you have a long-term care need, which, let's face it, is not very unlikely in old age. We can access a portion of the death benefit if the insured becomes chronically ill. What is the definition of chronically ill? This is a fairly standard definition for chronic illness or long-term care, which is if the insured is unable to perform at least 2 out of the 6 activities of daily living: bathing, transferring, dressing, eating, continence, or toileting, or has a severe cognitive impairment, typically Alzheimer's or dementia. This is a very standard definition. This would qualify you for long-term care. And it has to be for at least 90 consecutive days. It has to be a chronic illness, not a short-term thing, not a one-week thing, a long-term need. Notice that you would need a licensed healthcare practitioner to provide a certification. This is nice because it's not the insurance company determining whether you meet the long-term care definition. It's your doctor. Keyword is your doctor. You go to your doctor, whom you trust, who knows you, who has a relationship with you, and he will be the one to sign the document saying, yes, this person meets the need for long-term care. So that's actually really nice. So once they have that document, once they have your doctor signing off that you have this need, then this is indemnity based, meaning it's not reimbursement based. You can use this benefit for whatever you want. Very similar to the other accelerated death benefit. It's totally flexible. It's not like health insurance where you submit a claim saying, I spend $10,000 on this treatment. And then the insurance company reviews it, decides whether it was appropriate, probably denies your claim, probably makes you fight. But maybe if you're lucky, they'll approve your claim, and then you get a $10,000 reimbursement, probably minus whatever your deductible is. That's not how this works. This is indemnity based. Once you meet that definition and your doctor signs off on it, you can now collect that death benefit advance. That's what we mean by indemnity based. It's totally flexible. It's a cash benefit, and you can spend it however you want. Maybe you need to make modifications to your house because it's harder for you to get around. You need to install an elevator. You need to install some bars in your shower. Maybe you need to hire a full-time nurse, a nanny for some children that you're watching, anything like that. Maybe you need to hire someone to take care of the pets because you cannot take care of the pets anymore. Maybe you want to hire a chef to cook for you. Maybe you have to pay more for food that's prepared because you're not able to cook for yourself as well anymore. All these things you could spend the money on. It's totally up to you. That total flexibility is really important and is one of the ways in which I think these are actually better than, or at least more flexible than, a long-term care insurance policy. Of course, nothing wrong with long-term care insurance policy either. They have their advantages. I sell those too. They're perfectly fine. So again, this rider is not a long-term care policy or nursing home insurance policy. It is an added benefit on top of your whole life insurance policy where you can access what you've already paid for, which is that permanent death benefit, ahead of time. We're going to go through an example here. You have to have that doctor recertify you every 12 months that you still have this long-term care need, because hopefully you get over it very quickly and then you're back to normal, healthy living and you don't need this anymore. That would be ideal. But if not, every 12 months, your doctor just has to recertify that, yes, he still needs this. Yes, we're still working with him. The minimum amount you could take would be $4,800 every year. And the maximum is basically set by the IRS. It's basically based on IRS tax codes. It's either 24% of the death benefit, that's the maximum you can take, or $240,000 a year, whichever is less. And that $240,000 is or the per diem limitation. The IRS determines how much in benefits you can take while still remaining tax-free. If you go above a certain level, the IRS might consider it taxable income. But as long as we stay under their per diem limit, it's still considered an insurance claim, and therefore it's not taxable. That's currently $240,000 a year. Presumably that will go up every single year because of inflation. And of course, your death benefit goes up every single year. So this is a beautiful way of protecting yourself against long-term care, where you're also protected against inflation, because the amount that you can use is going to go up. It goes up every year based on the death benefit going up, and it goes up every year based on the IRS per diem limitation going up, sort of indexed to inflation. You have to keep some remaining death benefit, and when you use this, at least $50,000 to keep the policy in force. If you were to pull everything out of the policy, you would still have to leave a $50,000 death benefit, which is actually a nice feature because it still ensures everything stays tax-free. Because if you surrender the policy, there could be tax consequences. And then it leaves money to pay for final expenses, to sell your estate, pay for the funeral. Again, qualify for favorable IRS tax treatment because it's an insurance claim and not taxable income. It's not a capital gain. It's a benefit paid by the chronic illness rider. It's not long-term care insurance. And it's distinguishing it from the accelerated benefit rider. This will reduce your death benefits. So there's some complex math behind that I'm not going to go into. But again, you have that discounted death benefit where if you were to take $250,000 in benefits, your death benefit wouldn't be reduced by $250,000. It would be reduced probably by more than that because they're going to discount it based on a few different factors. You'd have to be an actuary and or an underwriter to understand that, but just keep that in mind. So if you have $1 million death benefit, you in theory have $1 million bucket that you could use for long-term care, but it's muddier than that because you have to leave $50,000 in the policy to keep the policy in force. Then when you advance yourself that death benefit, it's going to be discounted by more than the dollars you use. And then, of course, you could have less if you had borrowed out cash value or surrendered cash value. That would also reduce the death benefit accordingly. Now we go through a hypothetical example. So here again, at issue, we're 35 years old. Then at 54, which would be relatively young for having a long-term care need, typically this is something that's going to happen after age 65. But 54, in this example, he takes $153,300 worth of benefits. Again, the interest rate that we're going to be discounting by is 5.3%. So in this example, the premium was $25,000 before he got that benefit. Afterwards, presumably he survives, he gets better, he gets back to normal living. He wants to keep the policy in force. The premium is now $22,878 because it's a smaller death benefit. So therefore, less premium is required. He had $756,000 of cash value. After using this benefit, he now has $626,000 in cash value. And his total death benefit went down from 1.9 million to about 1.6 million. So I'm going to pull up my calculator again. $1,910,482 minus 1574872. Your death benefit was reduced by $363,000. You took $153,000 worth of benefits, but your death benefit was reduced by more than double that amount. That's because of the discount rate that they're applying. And also because you're only 54 years old, it's a fairly young age to have a long-term care need, so the death benefit would be reduced more. If you had done this at age 85, the discount rate would be significantly less. And then it may, in fact, only have been a dollar for dollar reduction, where if you used $150,000, your death benefit was only reduced by $150,000, because that's about the age at which you'd expect to have some form of long-term care need. This is getting really deep into the weeds. I don't know if this is helpful for the audience, maybe only for other life insurance agents, but we'll keep going. This is probably super dry and boring, but some of this might be helpful to the audience. Then we have the overloan protection benefit rider. This prevents your policy from lapsing if you accidentally overloaned it. If any outstanding loan exceeds 99% of the cash value, then it essentially locks up the policy. The policy remains intact as a paid-up policy. It ensures that your policy will not lapse. If you're being responsible and being an honest banker, this should never, ever, ever be an issue, especially the way that we design and utilize policies. But it is nice to know that you have this added layer of protection in case you needed it. When a policy becomes a paid-up policy, you can see how this works. All supplemental riders will be terminated. No further premium loans or policy loans will be allowed, and no further changes can be made to the policy. So again, it locks up your policy in a good way to prevent it from lapsing, to protect you, because you don't want the policy to lapse. This rider only takes effect when you're at least 75 years old and the policy has been enforced for at least 15 years. There is some legalese here about how the IRS has not officially ruled on this. I don't think this is very likely, but it's possible the IRS could view this as a surrender and potentially make it taxable. So the insurance company is covering itself just by making note of that. I don't think that would happen. I think there's been enough of this that the IRS is aware of this and they wouldn't do this, but it is theoretically possible. If you were irresponsible with your policy, you had overloaned it, and this overloan protection rider then protected your policy from lapsing, it's possible the IRS at some point in the future could decide that that is the same as a surrender, and they're going to treat it as a taxable event. I think even if they did that, which is extremely unlikely, but even if they did that, they would grandfather in policies that had already been in existence. I think it would also be politically extremely difficult, because it would look like whatever administration is in charge and is taking advantage of old people in retirement who probably were using policy loans to pay for health care and things like that and ran into financial trouble, and now the IRS is penalizing them. That probably wouldn't be very politically viable. So I don't think it's likely. It's never happened, but it is good to know. And again, this overloan protection rider should be something that you never use if you're being responsible, but it is nice to know that this is there as some added protection. So very dry and boring and technical. We're just going through some legalese, contractual language. This is why life insurance agents generally don't do this, because it's typically not very helpful for the client. But now you're armed with this information, we will continue with our walkthrough of this policy contractual language next time.